What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is May 14th of 2020. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, I not only want to spend some time to talk about the continued surge we've been seeing in Bitcoin post the halving event, but along with that as well, talk about the developments in regards to the housing market and how I feel with what's been going on over the last few months that we can not only be entering into a very clear recession, but possibly a depression across the board, even in the housing market. So we've got a lot of things to discuss right after our quick sponsor. Our sponsor for today's episode is Bitpanda Pro. If you're on the hunt for a proven, trustworthy exchange in Europe to trade your crypto, then I recommend taking a look at Bitpanda. If you're just getting started, many people refer to Bitpanda as the European Coinbase, so it can be a great place to start in getting your first crypto positions. With over 5 years of experience serving the industry by offering easy and secure access to digital currencies, Bitpanda has really earned its reputation. Check out the link down below in the description for more information. Alrighty, everyone, so let's go ahead and spend some time to take a look across the board for the market. As we can see, over the last 24 hours, the vast majority of cryptocurrencies are in green territory, with very few exceptions down in the red. And interestingly enough as well, it's important to notice that Bitcoin is really leading the way here, with very few exceptions outperforming it, especially when it's up 7.24%, and has been continuing to show signaled strength over the last few weeks as we've been going through the halving event. But we do have two exceptions up here alongside a few others that happen to be some of our favorite plays, Energy and Unibright, two plays that we've been supportive of for a very long period of time. So it's really good to see both of these in double-digit territory, charging forward and helping to lead the market in an environment that's not really favoring altcoins at the moment. Now, one thing I wanted to share real quick before we dive into Bitcoin's price is I'm actually going to be attending a live stream event on Cointelegraph with Dan from the Chart Guys. Now, if you guys have not checked out Dan or the work of his other individuals on the team at Chart Guys, I highly recommend you check them out. They're not only a great resource for learning about how to read price action and trade in the markets outside of crypto as well as in crypto, but I just really admire Dan's perspective. I know I've done these Cointelegraph events before, and those sometimes I think they try to kind of spark a debate and stuff. It's going to be difficult for Dan and I to probably debate because we think a lot alike. At the same time, I think you'll get a lot of valuable information just kind of hearing from each of our perspectives, because I bet no matter what, we'll probably have a different perspective or two on certain things, or maybe view things in a different light. All in all, though, really recommend you guys check it out. I'm really humbled to be speaking with Dan, as I've been a big fan of him for a while. But speaking about trading, let's go ahead and talk a little bit about what's been happening here in the short term in regards to cryptocurrency markets. We have been seeing a really nice uptick in price here over the last 3 days after the sell-off that we got in the halving of it. It's almost a reversal of what we had here over the last 4 days. It looks like we're very much coming up to possibly retest back up to that big even level of $10,000 and possibly press up towards a line of resistance that we've talked about elsewhere that could lead us towards $11,000. So I want to go ahead and actually dive into that, right? I want to first emphasize here, as I have on my Coinbase chart, that we tested a very key level of support after the halving event and have had a really strong post rally after the close of the halving, right? So again, no matter what's happening with hashing rate, no matter what's happening in the mining space, people are buying into Bitcoin post-halving event here. They're understanding in this case, I think, as we're getting a little bit more awareness here. I don't think we've fully priced it in, and that's my point I've always brought up. You can't fully price in the halving event, right? But at the end of the day, I think some people are realizing that in this case, Bitcoin's reduction in supply is very favorable in this macro environment. And again, as we talked, even though we had considered the idea that this could come down to the low $7,000 range, if it were to hold at this range, we could very well have something that doesn't usually happen, and that is a kind of early rally here in this case, where prices start to move higher and build a higher base of support. And I'll go ahead and demonstrate that. We have that here in our Bitstamp chart for Bitcoin. We can see here that we had drawn back over the last few weeks this idea where, as we were getting the rally into the halving event, that we might actually come up here towards around 11,000 and start to build a higher base of support on what was previously resistance. So let's zoom out of the chart so this becomes a little bit more obvious, and I'll take it here to the weekly to become even more obvious. So why would there be a chance that it come up to 11,000? Why would we hit resistance at that point? Well, there's 2 points that I want to bring up. As we analyze gold markets, as we talked about probably in a few videos ago, and I'll go ahead and just bring it up for transparency's sake so you guys can understand what I'm talking about. You can see here on the longer term chart that gold had been hitting consistent resistance for a very long period of time. In fact, there was actually 3 previous highs, and then along with that, we got above here on the 4th try against that line of resistance, made it support, and continued on to one of the strongest rallies we've seen since back here during 2000 and 2009. So again, really interesting to see how gold did something that we've seen in a lot of markets. It came above the resistance, made its support, and through price signaled that it wants to move higher. Bitcoin could very well be doing the exact same thing. If we take a look here, right? Taking a look at the logarithmic chart, we can see here that Bitcoin has been charging forward ever since we had the low down here on the line of support, and doesn't look like it wants to come down here at all in the next coming months. So if price does push here, really in the next couple of days, as Bitcoin markets are trading 24/7, whether it's into the weekend or early next week, if we push above this line and have a close, that's going to be huge. And it's likely going to mean that we're going to come up here to 11,000 and then eventually come back down here to test support. Now, why do I believe 11,000? Well, it's not only a relatively decent level above this line of resistance that could easily be met over the next week or so, but along with that, you can see we've got a really interesting line that takes in both resistance and support between a lot of different significant areas or kind of points of price action for Bitcoin. The resistance over here in February, the resistance here in October of 2019, and also a multiple tested level of support here back during the time after we had the rally up to 14K. And you also line that up as well with a point of resistance over here. We can keep stretching that through and probably line that up here with a lot of points of support back here during the rally and also the beginning of the bear market. I don't want to stretch it too far, but I think that this is a relatively reasonable level to see here for price action. And that for a couple of weeks or months, we could come to contest this line of resistance and make it support and eventually start to kickstart the new cycle here for Bitcoin, where we not only get above 20K sometime in late 2020 or early 2021, but that we start to spark off to the new rally throughout 2021 and 2022. Anyways, that's my general thesis for now. I'd like to hear what you all think about it. Do you think that we've got enough volume for this? Do you think that we have the capacity for price to move up that high, or that we need to come down to 5 or 6K? Love to hear from you guys down below in the description, or I said that again, down below in the comments. But I want to make sure you guys provide some thesis or some thoughts as to why you believe that's going to happen. I think for me, my general points are pretty clear here in the sense of the continued trend. I don't want to fight the trend here. It's multiple weeks of green, coming in really strong, and volume right now is relatively good if you take a look at BLX. Right, BLX will showcase to you that we've got some pretty decent volume, at least compared to what we had back here. So we'll have to see if we get a continuation of that. And again, this is midway through the week here, right? So we'll have to see if we get the same kind of volume that we got over the last 2 weeks. Anyways, let's go ahead, dive a little bit further. ScalpX index showing Bitcoin is not oversold, which is good to see. But I want to go ahead and talk a little bit about traditional markets here. So if you didn't think the Fed, the ECB, the Bank of Japan, and the People's Bank of China are doing everything in their power to keep the financial system afloat, just take a look at this Yardeni research chart here, where as they update their data on a daily basis, or I guess maybe on a weekly or so basis, the amount of stimulus that we've had is so big, it's going off the chart. So we've seen central banks adding trillions of dollars of liquidity and have committed to already adding even more in regards to liquidity, trillions of more in liquidity that we have yet to even see materialize not only here in the chart but in the real world economy. Now, as we talk about this topic, as I emphasized earlier, I want to discuss the housing market and talk about where capital's flowing here. To start off as a precursor, you would think that the Fed, who claims to be, noble in their intentions about getting liquidity out into the real economy, would make sure that they guarantee that that liquidity is going to be reaching your pockets, that it is going to be coming out in the form of loans at low interest rates, as they're pretty much near zero now, just people getting mortgages for their properties, getting small business loans, doing things of that sort that would help you, right? Or maybe giving direct credit lines to people who might need money in the short term to cover expenditures, especially at these nice, lucrative, low interest rates. Well, it's not exactly what they're doing, because as the Fed is picking up quantitative easing at a record pace, and it is set to outpace by far what we've done here back in 2008, 2009, even though we have this record amount of QE coming in, at the same time, it's really not flowing into your pockets. It's going into the pockets of hedge funds. It's going into the pockets of people who own equities. Or it's inevitably finding its way into the hands of people who inevitably will take the cash that they get for converting toxic assets through QE programs and injecting it into equity markets. It's their best bet. So we can see here that, for example, a lot of the FANG stocks, or the new FANGMAN index that was put together here on LMT, or on the ISBELnet, We can see here that it's taking into account Facebook, Amazon, Netflix, Google. We also have Microsoft, and then I think Apple, and I'm trying to think of the end here. I know it's not Netflix because we already have that. Let's see. I think they listed it out here. Oh, it's NVIDIA, right? So all the tech stocks are doing great, right? The speculation is rampant in regards to tech stocks. But this is something we have to talk about here. Mortgage loans past due against unemployment rate. We have a massive spike in unemployment, over 14%, the highest level we have seen since the Great Depression in the United States. Now, I can understand some people are going to say, Nick, that number's artificially high because people are being forced to stay home. 2 points I want to bring up. First off, yes, that's true. I have no doubt about that. But the first point I'd say to keep in mind is that don't believe the economic models that are coming out stating in a very optimistic tone that this is going to be dropping down to 6% afterwards. It is not. This is the new normal, folks. I will put my money where my mouth is in this case and saying that I have no doubt, if I could place a bet on it, that we are going to stay above double-digit territory for the next preceding year. That's very sad to say that. I hate to say it. It's not something I look forward to, and I'm not doing it just because I want it to stay out there. There's no reason for me to want that. To be realistic, to be probable with you all, it is likely that we are going to remain above double-digit territory, even with this rampant amount of Fed stimulus, because they're not placing the stimulus in the proper position. And along with that, we just saw the other day, for 3 months, California is going to continue to extend their stay-at-home orders. We're seeing this in other areas across the country. And no matter where you stand on the policy, that's what's happening. So until we get a change in course on that, until we start seeing Fed monetary policy in the mindset of helping everyday people rather than Wall Street, unemployment's going to stay where it's at. Small businesses are not going to be able to suffice. I can tell you all, where I live along the East Coast, it's not looking too pretty. And we're one of the less hard-hit areas than other areas across the country that are looking to extend even further. Just these past few months of business being frozen, I think people don't comprehend just how small of an amount of cash that most small businesses have at their disposal. And sure, some are getting small business loans. Yeah, sure, understandable. But this is where the second factor comes in. These psychological ramifications are going to be huge for the economy. So we're talking about the broader economy here, right, for unemployment rate. That's one of the data pieces here. But we got to talk about mortgage loans past due, right? So we not only have this issue here where people are going to have a huge delinquency rate. They're not going to be able to pay back their mortgages as we see. We see a direct correlation here. In the past, it was where mortgage loans had actually, started to become past due and become delinquent before unemployment. Now we're going to see the opposite as unemployment has come in shockingly quick, faster than any time we've ever seen in history. So here's the good chart here. But I want to talk about a broader issue. Right? This is one key issue that we're already going to have a broader delinquency rate. As we get an increase in that delinquency rate, we're going to see a freeze in the lending market amongst commercial banks. And we're already starting to see it. We are already starting to see it. Lending standards are getting to their tightest levels that we've seen since back in 2008. I would say probably even 2009, 2010. This is very important to keep in mind. If we take a look down here, we can see a really interesting chart that takes in the demand for commercial loans at the moment, the percentage change here. And as we can see, commercial loans for mortgages are staying relatively unchanged here in April, even with the downturn. People are still looking to get properties. Well, this is an inversion here of credit standards, meaning that they're setting higher and higher restrictions on who can actually take out a home mortgage. You would think the Fed would have a tad bit of foresight if it was going to print trillions of dollars liquidity to inject capital into the financial system, that they would say, hey, commercial banks, maybe lower your standards a bit. All right, if we're going to make a lot of funny money, let's open it up to people. Don't deny people for mortgages, right? But they're not going to do that. And quite frankly, I don't really blame the banks, because you don't want to lend out to someone who can't pay it back, right? That's exactly what happened back in the early 2000s that led to 2008, right? So the Fed's not even playing this game of, hey, let's just artificially provide relief in the short term for everyday people. No, they've just made it very clear that through their actions, they're supplementing the biggest equity bubble in history, equities of which are owned by a vast majority of very affluent and wealthy people, not everyday Americans, where their major cost is their rent, their mortgage, their living expenditures. No, they don't care about that, right? It's virtue signaling. It's virtue signaling, claiming that they actually want to help everyday people, because either they're too incompetent to do it and they don't realize that the liquidity is not flowing to you at the end of the day, or they just really don't care. This right here is a chart here of the credit squeeze, the tightening lending standards. And the article messes up here a bit. I don't know if they had an error on their end in producing this, but this is a good percentage here. A net percentage of banks tightening lending standards. This is back in April. I think we'll be damned to see what happens in May. I mean, this is going to be really brutal, guys. I just don't know what this is going to do to the housing market. I can tell you, though, it's not going to be favorable for prices. And as housing prices go down, as the value of these assets go down, as there's less buyers, it's going to mean less collateral. It's going to mean less asset or net worth of individuals in order to go out and make other purchases, to make other investments, or to be able to take out loans. It's very scary stuff, guys. Very scary. And again, talking about seeing this already in the trends. Take a look at new home sales, newly built homes in the United States. Month-over-month data here in this case. Biggest deviation off of the trend that we've had for the last 10 years in history. Last 10 years, biggest deviation here. If we drop another month or two, do you think that people looking at this 10-year trend are going to get optimistic on building new homes or buying new homes? How about here, for example, on existing home sales? An already weak enough trend here over the last 10 years. Now, almost treating the trend line here as resistance. Again, I don't want to do TA here on it, but you can do TA in a sense, or you can at least understand when a trend is deviating, right? Major drop here. We can see here in certain regions, massive drops here amongst the coronavirus outbreak. If this is a time period where you all are looking to possibly buy your first property or rent a new place somewhere else, over the next coming months, I think you're going to have an opportunity to start seeing some discounted prices. But all in all, look, even though this might be a benefit for some, it makes me upset. It really makes me upset for people who bought mortgages right before all of this. It makes me upset that the Fed and central banks, though they claim that they want to help the direct economy. And I understand some people will make the argument that through the Fed providing liquidity to hedge funds and providing it to commercial banks, that this is somehow going to, again, kind of have a trickle-down effect in this case. This idea that, again, if we provide liquidity to these upper layers, in this case, in the financial system, that it will start to work its way down through commercial loans, that it's going to come through the form of small business loans, that it's going to eventually come down to help you. And they say that they just can't, for some odd reason, they can print billions of dollars and deposit it into the accounts of hedge funds who took excessive risk on toxic assets like high-yield bonds that were likely to default, but they can't print money and deliver it to your account digitally within a matter of seconds like they can do for hedge funds. Really? They just can't do it. The rules they have set for themselves don't allow for them to do it. Well, why the hell can they not revoke it and start giving you a paycheck? Why do we have to wait for the Treasury through their terrible paycheck protection program system through the IRS? Why do we have to wait for that? Anyways, I could ramble on for hours, but I think you guys feel similar to heart to where I feel on it. Again, this is just ridiculous. And it's going to have ramifications not only for everyday people, but if this keeps up, all those asset owners, all those people who had Airbnbs, properties that they'd flipped into Airbnbs, making rent every month, being able to pay down basically the mortgage in this case through the payments that they were getting from people who were staying or they were renting out in this case, right? That's been a big thing in the last few years. That bubble's going to pop. All the people who bought investment properties, from Berkshire Hathaway to maybe small and medium-sized property investors, sorry, it's going to hurt you. And that's the reason why you always want to prioritize the end consumer, because eventually it will come down to bite people in the butt who think that they can continue to ride an asset bubble and hurt the everyday people in the crosshairs in this case and leave people behind. Anyways, I've rambled on enough for today, guys. I hope you all have enjoyed this video. If you liked it, please drop a like. It's always appreciated, helps out the channel. And along with that as well, if you're new to the channel and you enjoy what you see and want to hear more of it, definitely consider subscribing, hitting the bell icon to make sure you don't miss a video. But all in all, guys, I really appreciate you continuing to stick around. I just realized the other day we got over, I think it was like 340-something thousand subscribers. It's pretty incredible to think that we have such a large audience and that you guys continue to support me here on the channel. It really means a lot, and I enjoy doing what I do. So I hope you all are having a fantastic day wherever you are, and I'll see you all in the next video. Stay tuned.